We'll be doing product review as well as the market review. I'll be talking about what happened last month in market across segments, and we'll be also talking about how uh, our funds, various sectors, and various market indices behaved last month itself. So, without any further delay, I'll share my presentation, and then in this presentation, I'll be first talking about happenings in the market, and then I'll be talking about the fund performance, and I'll be also talking about how underlying stocks have performed in major broad-based indices like Nifty 50. Then I'll be also talking about how underlying stocks have affected the performance of Nifty Next 50 alpha and low volatility. So, first of all, a very quick snapshot of what has happened in last 1 month. I think after three very volatile months of Jan, Feb, and March, and saw significant amount of corrections and volatility because far higher than what market was expecting. It was levied across the globe and even on India. Relatively, we were better placed. So market in India sort of reacted relatively better by falling less than how markets reacted in China, in US, and in several other countries where the impact was significantly higher. I think then the market started sort of recovering when Trump announced that there will be a pause in tariffs for 90 days, and since then we have seen equity markets in India relatively doing better. We in fact seen relatively better performance in US markets also, because what market is reading increasingly is that there are deals to be made, especially with relatively friendly countries like India, Japan, etc. And even we are seeing some sort of softening when it comes to US-China relationship. So eventually, the market is expecting that some amount of compromise will be made, and if that doesn't happen, we may expect another bout of corrections and volatility. So let's first talk about India. What happened in last 1 month? This was also accompanied by obviously the earning numbers coming out, where especially on the banking side, we had some sorts of positive sentiments because of the earnings. So Nifty moved up in last 1 month by 3.5%, and now we see that it is only down by 7% from its 52-week high. So if you remember, it was down almost 12-13% a month back or so, but after this recovery, we are seeing Nifty only down by 7% from its 52-week high. It's up by 3.5%. When we are looking at mid cap, has also sorts of recovered by almost 4% this month. It is down around 20, it's down around just 12% from its 52-week high. Again, if audience remember, by the end of last month it was somewhere around 18-20% down from its 52-week high. Small cap is also recovered, not so much, 1.7% up only, and it's down around 18% from its 52-week high. So recovery in small cap has been a bit on the laggard side. Next 50, which is the third line, as you can see, that is one index which had corrected significantly. Don't see any strength there yet. It's only recovered by 2.3%, and still down by 17% from its 50. Word is the sorts of that NSE Financial Services up by 4.7%. services, as you see, banks have contributed, the financial services have contributed to the recovery of Nifty and Sensex more and more. They have lower representation in next 50, and that is why you see that next 50 has not recovered much. And so is small cap, right? The most of the rally which we have seen is in the top tier banks, and obviously small cap does not capture that particular segment. So apart from banking, we have seen some sort of rally in oil and gas index, but I think that is more so pertinent to sorts of rally which we saw in Reliance stock recently. So BSE oil and gas, you will sorts of don't allude it to the sector, but allude it to the top holding, which is Sensex. And then as we go down, one very interesting thing is that there is recovery in consumption also. So in last 1 month, if you look at India consumption, it is up by 5.6%. FMCG is up by 5.3%, consumer durable is up by 5.7%, and auto is up by 4.8%. So, like like banks, financial services, consumption is also seen a good April, and that is sorts of what has resulted in a good performance of sectors in financial services and consumption segment. Consumption, even though it has recovered, let's say India consumption is up by 5.6%, from a 52-week high, it is still down by 13%. The only thing which is hovering around its 52-week high, as you can see, is financial services and banks, including private banks. Now, a sector which has not done well yet is metals, and that can be obviously alluded to the weakness and the concern around global growth, which we are obviously debating about due to concerns of Trump tariffs. So metal is down by 5.6%, and so is IT, which is down by 2.8% last month. So now, if you are looking from a 52-week high, quick summarization: Nifty is down by 7%, mid cap is down by 12%, small cap is down by 18%. If you remember, small cap and mid cap both were down more than 20% respectively. So there's a reasonable recovery. Now, segments which are down more than 20% remains your oil and gas, utilities, power, energy, etc., with a significant correction also being witnessed on the media side, which is still down by 31%. Continuously seeing weak in terms of 22%, as it is significantly impacted by strength of US economy, where down by 0.3%. On the recent performance, very interestingly, before I move to the next slide, even after all this turmoil, if you look at 3-year data, 2% return, small cap has given 18% return. If you go down, capital goods have given 32% return. Alpha has given 22% return. So if you look at the data, you will realize that in spite of all this volatility, corrections from 52-week high recovery which has happened in April, we're still looking at a reasonably okay 3 years number, which just simply says that it's better to stay invested in the market. Volatility will come and go, but longer you stay in the market, more likely you will navigate this volatility, and your long-term returns will be good. From a PE point of view, I think it's pretty straightforward now. Nifty has recovered, so uh, we were talking about Nifty around its long-term term average. Now it is trading at a bit of a premium. So we are looking at a 8% premium when we are comparing the current Nifty estimated PE, 12-month forward PE, to its 10-year average. So 10-year average is 19.2. Current 12-month forward is around 20.8. So we are looking at 8% premium. If you're looking at next 50, it is trading at a 22% discount. If you're looking at mid cap and small cap, they are trading at 9 and 25% premium respectively. So mid cap and small cap are still at premium. Nifty 50 now at premium at around 8%, and next 50, while the number shows it is minus 2%, but the index composition has changed significantly, so it's not apple versus apple comparison. So if you would have compared the current composition and the current composition's PE in last 10 years, I assume that you will even see this index currently at premium as well. From valuation point of view, like we talked about last month also, the one which is from a sector point of view, one which is still looking lucrative is financial services and banking. Other segments continue to sorts of trade at premium compared to its 10-year P. Now, very quickly, I think we all are obviously interested on what is happening globally. So this month was very volatile for US market. If you are concerned about the volatility which is happening in India, I just request you to go ahead and see what is happening in the US market, especially at the stock level. So markets are very volatile, but now if you're looking at 1 month data, NYSE FANG Plus Index, on which we have an ETF as well as fund of fund, that moved closed up by 7.2% compared to just 1.6% of up move by Nasdaq. Whereas on the contra side, S&P 500 and S&P 500 top 50 closed down by 0.4%, right? So what we are seeing in US actually did well in last 1.5 or Alpha for and obviously stock and then their stocks moved up, helped the narrative that there will be these big tech companies will be able to navigate Trump imposing tariffs. And for example, that Apple has come out and said that most of the products which will be imported in US will be made in India and Vietnam, and hence they will be sorts of using their supply chain and doing the alteration so that the effect of tariffs can be negated. On the other hand, the companies like Alphabet continue to show very good sorts of earning numbers, especially from advertising and other bets. So if you look at Microsoft and Meta also sorts of showed very good earning numbers, and that is why you see that FANG Plus has done relatively better because big tech earnings have sorts of given a very strong momentum to stock prices of Mag 7, whereas you see that Nasdaq 100 has relatively not done well in past 1 month. Uh, if we compare that with sorts of 52-week data, then FANG is down by around 10%, Nasdaq is down by around 11%. It is also interesting to see how AI index is doing, and we have a fund of fund on that particular index. It's a global tech product, so it has 70% US, 30% non-US, including around 15% China. Then it has exposure to tech companies from Japan, Korea, etc. That also has moved up by 1.9%, and that is down around 13% from its sort of 52-week high. Now, moving to S&P 500, I think that is where I personally believe that you will see we are seeing a more impact of tariff related issues, because it consists of all your consumption companies, etc., which will be negatively impacted because of higher input cost. And you can see that that's why probably in last 1 month they have sorts of given negative returns, and S&P 500 is down almost 8% from its 52-week high. Coming to China, China obviously was volatile as expected. It will continue to be choppy till any sorts of deal is reached with US, or we see sign of softening of both stance by Donald Trump and the Chinese government. But but because of what is happening, you see, obviously, Hang Seng Index and MSCI China all correcting around 4 to 5% in last 1 month. Uh, we all know that China market has done really well in last one and a half year. Hang Seng Tech gave almost 39-40% return in last 1 year, but now from its 52-week high, it is down by almost 15%. Or so. But from a valuation attractive, you see down from its interestingly, rating has happened because of good earnings, etc. And now you see FANG only trading at a 3% premium to its 10-year average. That FANG after correction and then after post recovery due to re-rating, interesting to know. Whereas if you look at S&P 500, that is trading at roughly around 11% premium to its 10-year average. Now, let's talk about stock drawdowns in domestic market, right? We talked about how Nifty 50 recovered, how mid cap and small cap has performed, and obviously how from a sector point of view, consumption and banking doing well relative to other segments, and how IT and metal has not done well. But let's look at stock level data, and the numbers which you are seeing in sorts of top two table is from NSC Total Market Index. So Total Market Index consists of 750 stocks, all large cap, all mid cap, all small cap, and 250 micro caps. So 750 stocks. So on the top left, you are seeing how much correction has happened, right? And from 52-week high, especially in last 1/6 YTD basis. And on the right hand side, you are seeing how many stocks have given positive returns, right? So I've tried to put both correction as well as recovery on a single slide. So apologies if it seems a bit too much or confusing, but I'll try to explain it in a simple language. So in last 1 month, if you look at top left table, 53 stocks have corrected by by let's say by 10% or so. Then there are no stocks which have corrected uh, more than 50%. There's one stock which is down by 30% or more, four stocks which are down by 20% or more, and only 53 stocks which are down by 10% or more. Now, just compare it with what was happening on a YTD basis. So YTD is almost 4 months now. So in on a YTD basis, four stocks are down by more than 50%, 83 stocks are down by more than 30%, 241 stocks are down by more than 20%. And if we compare it with 52-week high, the number is more stark, right? There are 51 stocks which are down more than 50%, 388 stocks which are down by more than 30%, 572 stocks which are down more than 20%. So number looks stark, but this was much bigger. If you have been attending this webinar in past 2-3 months, the number which were there for 52-week high, more than 30%. So if I remember correctly, they were, I think, around 500, 600 stocks, right? And why the numbers have shifted, you can see on the right side. So in last 1 month, almost 400 stocks have given positive returns out of 750. 86 stocks have moved up by more than 10%. 16 stocks have moved up by more than 20%. And three stocks have moved up by more than 30%. From 52-week low, 137 stocks have moved up by 50%. 294 stocks have moved up by 20%, more than 20%. So we have been seeing a lot of volatility. Initial period till I think Jan Feb, you are seeing more than 30 and 50%. Now we are seeing some recovery happening, and that's us seeing the data on the right hand side, right table, which just highlights that the 137 stocks have recovered more than 50% from its 52-week low. Now, if we talk from an index level point of view, and look at Nifty 50, Next 50, and total market. So, from a drawdown point of view, it's interesting, right? In Nifty 50, from 52-week high, only eight stocks are below, have corrected more than 30% now, right? Uh, Whereas in next 50 there are 13 stocks which have corrected more than 30%, and in total market cap that number is around 83 from its 52-week uh, high. Now, yeah. Now, if you are looking from a recovery point of view, Nifty 50, there are from 52-week low, we are seeing almost 16 stocks recovering 30%, six stocks recovering 40%, and two stocks recovering around around 50%. Next 50, the data becomes more skewed. You see four stocks recovering 50%, seven stocks recovering 40%, and 12 stocks recovering 30%. So point being that that while the correction was broad, right, there were corrections left, right, and center. Recovery has also been broad. We are seeing a broader recovery across the market. Now, these are the indices which are sorts of managed. We have products on these indices. So we have not mentioned sectoral indices here. We have Nifty Bank, PSU Bank, IT, etc. But the idea was to talk about products which we manage right now. So like I mentioned, that Nifty 50, Next 50, mid cap, I've already covered. Low volatility is this one, which is interesting, right? I think a lot of effort went by in explaining the underperformance of low volatility. If you remember, right, low vol had poorly performed when it was expected to perform and expected to be stable, right? And that the reason behind that was that FMCG was one of the first sectors which started correcting after the companies gave poor September quarter numbers, and that's why sorts of low vol performed poorly earlier itself. But if you look at low vol number right now, 1 year is 10.1%, right? Where compared to Nifty 50, which is around 9%. So low vol has sorts of made a very reasonable comeback in last 1 2 month, where sorts of it has given a relatively sturdy performance. I think, like I mentioned, that apart from banking, consumption also has given relatively better performance in April itself, right? Also, some sort of recovery in Alpha also, which sorts of recovered 4.1%, and in 1 year is down by 4.4%. 2 year data is still at 32%. It has given 32% recovery, higher than what you see in Nifty 50, Next 50, mid cap, etc. Now, other products which we have is EV manufacturing and new age consumption. I think uh, EV EV and manufacturing 2 and 3% up. If you're looking at 1 year data, EV is down 4.4%. Obviously, auto has corrected deeply, and that impacts the performance of this particular product. Manufacturing is up by 4.8% on a 1 year basis. New age consumption, which consists of all the B2C discretionary companies. This particular product does not consist of any FMCG stocks or B2B stocks like auto ancillaries, etc. And this is something which we believe is one of the best themes right now. That is up by 4.3%, and on a 1 year basis, up by 7.6%. Select IPO is a ETF vehicle to invest in spin-offs and IPOs post-listing. The portfolio is very unique. It consists of newly listed IPOs and spin-offs, and that has given 5.1% return in last 1 month, and on a year basis, it is up by 4.2%. I've already talked about FANG and Hang Seng, so I won't spend much time into that. And I'll talk about gold and silver separately in one of the slides where I'm showing the charts. Now, from a valuation point of view, I've already sorts of explained that now if I'm comparing with 10-year average, so if you're looking at 10-year average, Nifty 50 is roughly around 8% premium. Mid cap and small cap is again at a reasonable premium also. Mid cap at 31 PE compared to 28.4. Nifty small cap is at 25 PE, whereas the 10-year average is around 20. So reasonable premium, low double digit premium in case of mid cap, and or high single digit, and in small cap also a double digit premium. The only sectors which are trading at relative discount compared to its again 10-year average is banking segment, like I mentioned earlier. FANG, like I mentioned, compared to its 10-year averages, is now roughly on par or around 2-3% premium, whereas interestingly S&P 500 is trading at a higher premium than FANG itself. Hang Seng Tech is at a discount of 37%, but please be careful of if you think of investing in Hang Seng Tech, because Chinese market I expect will continue to be volatile, and you never know how this entire trade negotiations will unfold. Now, what I'm doing is again, I'm going to talk about four products and how sorts of the movement of underlying stocks have affected the performance of these products. So, like you can see, just a moment, that that the banking stock right now, but in last 1 month, if I can say, of Nifty 50 as expected was Wipro itself. On a 3 month basis, look at the Wipro is down by almost 20%. So the biggest draggers in case of Nifty is Wipro, down by 20% on 3 month basis, 8% on a 1 month basis. Then come 4%. Trent and Tata Steel were both down by roughly. On the reason why you are seeing energy and oil doing well, because Reliance Industries had given a return of almost 13.3% in last 1 year. Positive impact also came from HDFC, ICICI, Reliance, Axis Bank up by 10%, Mahindra and Mahindra up by 10.7%. 7%. Interestingly, while because of low weightage, the impact will not be higher, but Geo Financial also moved up by 13%, and SBI Life Insurance roughly around 12.6%. So these were the stocks which sorts of contributed to a good performance of Nifty 50 last month. And there were, like I mentioned, some draggers like Wipro, Trent, Tata Steel, etc. Now we'll talk about next 50, and the top contributors in terms of performance were sorts of top stocks like I mentioned. Indigo up by 5%, HAL up by 5.8%, both up by more than 18% last 3 months. Then you have Divi's Lab up by 7.1%, both Godrej Consumers and BPCL up by 8 and 10% respectively. Bank of Baroda and United spreads up by 7.5 9.5% respectively. One of the biggest draggers was Vedanta, which sorts of down by 9.4%. If you look at contribution in terms of dragging, then Varun Beverages also at 4.5% because it has a higher weight in the index of more than 3%, and Indian Hotels, which has a weight of all more than 3%, again falling by 3.7%. The stock which in terms of absolute fell the highest was JSW Energy by 10%, and Swiggy also, which fell down by 10.4%. Now, I'll just talk about two smart beta products because a lot of queries come on how alpha and low volatility are doing. Alpha, most of the stocks are common with momentum also. So for listeners who would have invested in in momentum, I think roughly this in terms of at least stock performance, this will play out. Weightages will be different. So in alpha, you can see it's a mixed bag. So if you look at top stocks in terms of weightage, the weightage mentioned in the rightmost column, you see Bharti Airtel up by 4.8%, Mahindra and Mahindra up by 10.7%, Bharat Electronics, BSC Limited, double-digit returns, Dixon 23% up, and then you have Solar Industries 16% up, and Paytm almost 4% up. These were the tops. These are the top stocks. On the top stocks, weight is fairly distributed in alpha. But if you look at draggers, you have Trend at Vedanta again 9% again, and Glenmark. So I think companies sorts highest because it has a weightage of almost 4.4%, which is down by 9.4% and has a weight of almost 4.2%. I still believe that this is one of the best times to this year will be one of the best time to invest in alpha if you can stay invested for 5 7 years. We have recently done a lot of SIP and staggered investments related study on how alpha had performed historically, and if you stay invested for let's say 5 to 7 years and invest when there is a drawdown of around 20% or so, and invest in a staggered manner for 6 months, that 5 to 7 year returns look pretty good compared to the other indices. Now on the low vol side, again on the right side you can the uh, see the weightages, and you can see that a lot of uh, stocks which have relatively done well. So unlike alpha, we were seeing a mixed bag of stocks. You see HDFC, ICICI, Reliance giving good a positive impact to this particular portfolio. You have SBI Life Insurance also contributing significantly. Again, a bigger laggard being Wipro, like in case of Nifty 50, which is down by almost 7.9%, and I think other stocks which have fallen have not fallen much significantly. Like Infi only down 3%, Larsen and TCS roughly down around 2.5%. Now, that was all on the index, global indices. Uh, Talked about four products, how they have performed. Very quickly, in terms of market data, FII holdings, I think after for the first time this year, FIIs have turned positive. So in April, we saw net inflow of around 4,200 crores, which was obviously good because seeing that FIIs are returning back. I think one thing which we should obviously realize as is that even with, let's say, with Trump tariff, right, and it will have an impact obviously, but India still is better placed than competing economies like China, Vietnam, etc. Because they are the more higher tariffs are imposed on those economies. So I think probably that and very significant amount of domestic consumption, the fact that India is not so much coupled with global economy in terms of global trades. We do not have a very significant export to US. It's only around 2% of the GDP or so. So we our offered by what due to Trump government policies, right? And that is, I think again, talking about India, the more important thing is is when we will see recovery in our corporate earnings. I think that the stock market performance, while the stock market seen any significant improvement or guide done is you can see I have charted the last year Q4 earning, which is in blue, bottom range, then purple as line sorts of moves up every quarter earning, and you can see that across quarters the earning estimates have sorts of have remained on a downward trajectory only. So earning estimates haven't sorts of sequentially improved. Uh, this quarter also, while we are witnessing a bit better than expected results, but uh, nothing on the nothing which seems to be sorts of reviving the confidence that corporate earnings will improve significantly in coming 1.5 year, and that continues to get illustrated in this particular chart. So while earnings are okayish for this quarter, which whatever has come out yet, but I think for next 1.5 year, I think corporate earnings will continue to be in uh, low double digit. This again illustrates the same thing when we are looking at a CY estimates, right? You're looking at Nifty EPS being illustrated, as you can see in the chart, for FY25, FY26, and FY27. I've just given 24 as a base. So I think apart from Trump tariff, two important things which market will focus on is corporate earnings and obviously around consumption. If consumption is sorts of reviving in urban areas and shows strength in the rural areas. Now, very quickly on gold and silver. Obviously, we have seen pullback in gold prices. Intraday touched almost 3,500. I'm talking in terms of in international markets in dollar terms. It is down below 3,300. Last price was roughly around 3,225. So gold has pulled back, and this was widely expected. In our commentary also we said that this asset has moved far too quickly, and there will be some sort of consolidation in terms of price. There will be some correction. Having said that, the tailwinds, the factors which support gold prices continue, right? There is concern around U.S. economy. We expect inflation to become worse, geopolitical issues, tariff concerns, etc. Central bank is action is something which needs to be watched. It's very important how China will behave when it comes to is it just simply looking at will provide support to the gold prices? I think that is something which will be keenly watched, especially Chinese action will be something which will be driving the gold prices down and further strengthen a bit will depend a lot on central bank action, especially China. We can see that silver since mid of 2023 was sorts of tagging along with gold in terms of performance. And then sorts of a decoupled, right? Rally in silver, like anticipating, is dependent on industrial consumption, and if trade war worsens, there will be impact on Chinese economy. There will be impact on obviously exports from China, impact on demand of solar panels, EVs, etc. And that is, I think, what is keeping silver in a pretty tight range bound. And I think we should obviously see whether how this entire trade issue will play out. Now, a couple of last few slides, and this is around the dollar index movement. I think that has been the most surprising asset class, if you ask me, in terms of how it has behaved, because since the start of 2025, the market expectation was that dollar may perhaps strengthen or will perhaps remain the same level, but it has fallen significantly, right? Dollar index was roughly around 100, if you're looking if you, at the start of the year, around more than 105 and 107, 108, if I remember correctly, and now it is roughly around 100. In fact, I was just looking at data is below 100, I think 98, 99 or so. And uh, and uh, I think that is something which weakness in dollar has sorts of also supported the price of gold. Obviously, INR has sorts of also uh, performed better compared to the versus dollar in last few months. Also on the yield side, what we are seeing is the 10-year yield, which you can see in the white graph. Obviously, it moved up once Trump announced tariff, then sorts of corrected when he announced the fact that there will be a going to be a 90 days pause. And the recent movement has been because of the release of first the employment data, which just highlighted that there is weakness in labor market in US. Unemployment claims have increased, and but around then the manufacturing data came, which sorts of was below. ISM manufacturing was below 50, but it wasn't as weak as the market expected. So yield sorts of moved up. We're also seeing one very interesting thing, that there's US GSEC and 10-year US GSEC. You can see the graph itself between the white line as well as the blue line. One of the main news which is coming out, which will obviously impact US US markets and global markets is the GDP, the US GDP, which sorts of contracted, it sorts of GDP sorts of came out as negative 0.3%, increase in trade deficit billion in US, 160 billion. So what has been seen is that US businesses etc. have imported significantly higher in first 3 months just to sorts of offset uh, the Trump tariff getting effective. So sorts of they have imported more and more so that they can, before the imposition of tariff, they can import the required goods in US itself. And that is why you see that the imports itself had the highest amount of negative impact on the GDP numbers of almost 5 percentage points. You can see in the graph also. Interestingly, the positive impact came from uh, increase in private inventories, uh, and also sorts of business investments increased in the Q1, whereas consumer spending was on the positive side, but it was lower than the Q1 of 2024. If you're looking on the services side, on the goods side also it had a positive impact. So negative impact was driven by imports as well as uh, federal government spending because of the cutbacks due to Dodge, uh, which has been continuously sorts of implemented. Again, like you've seen the right side graph, that U.S. monthly goods trade deficit is now spiked uh, to more than $160 billion. Now, very quickly, in past 3 months, 12 months, we have seen good amount of inflows in ETFs as well as index fund. In last 3 months, almost 8,000 crores have come in Nifty 50 ETF. 4.7 thousand crores have come in Nifty 50 index funds. Sensex also has positive inflows. Very importantly, broad-based indices, other indices apart from Nifty and Sensex like Next 50 and other categories also saw positive inflows. Commodity, like a commodity as expected, because commodity did well, saw an inflow of almost 7,500 crores. Interestingly, even smart beta saw an inflow of almost 1,600 crores in last 3 months on the ETF side and 2,500 crores on the index fund side. Very interestingly, with volatility, what we have seen recently is that trading in ETFs have increased. So in last 3 months, on 1,900 crores being traded on a days, then Nifty 50. So Nifty 50 ETFs trade around 242 crores on a daily basis. This is now around 150 crores 3-month data. Last couple of slides, these are uh, uh, 20, 15 fund of funds. So we have a broad-based offering at all of them are on the lowest cost product, if not the lowest cost product. For example, Midcap 150 is at 5 basis point. Bank, IT, etc. are much lower in terms of TER than the peers. So in case of plain vanilla products, simple market cap based products, we have one of the best TERs in the market. Apart from that, we obviously have smart beta and thematic offerings. In themes, I like to highlight again new age consumption ETF, which focuses on discretionary consumption, focuses on consumer services, fintech, AMCs, autos, etc. I think discretionary wallet share of Indian consumer is going to increase, and and we are very positive on consumer discretionary right now. On the smart beta side, Alpha 30, it has corrected by more than 20%. I think staggered investment of around 6 months can be explored in this particular product. Yes, there may be volatility further, so think of doing staggered investment here. And keeping that money for at least 5 years or so. Apart from that, mid and small cap, which is a single product which invests in 50 mid cap stocks and 50 small cap stocks, chosen on the basis of momentum and quality and liquidity metrics. So three products which we feel are very interesting. Is obviously, like I mentioned, alpha, mid, small cap, new age consumption. And if you're looking at a broad based products, total market cap index fund, which invests in all 750 stocks, all large cap, mid cap, small cap, and 250 micro cap. And my favorite is Nifty 500 Multi-Cap 50 25 25 ETF. It invests in 500 stocks, 50% in large cap, top 100 stocks, 25% mid cap, 150 mid cap stocks, and 25% in small cap, 250 small cap stocks. It participates in the entire equity market in a very, I feel, preferable. In very preferable weightages, right? 50 large cap, 25 mid cap, and 25 small cap. So right now we manage more than 19,000 crores on a gross basis. A couple of slides which just talk about how well we are in terms of cost. Like I mentioned that our gold, silver, ETFs, Nifty ETFs are one of the lowest cost ETFs in the market. Our several other products like Nifty Midcap 150, Sensex, Next 50, Next 50, IT Bank, PSU Bank, liquid ETFs are the lowest cost product in the market. And one of the biggest advantage which Mira Asset ETFs has is that we are the only ones who have their own sister concerns as their market maker. So our market making is done by Mira Asset Capital Markets, who recently acquired Sharekhan. On a cost to cost basis at all times. Or subtract 14 basis point, which is the cost of construction of any ETF unit. STT is 10 basis point, brokerages 2.5, stamp duty is 14 basis point. At 14 basis point, you can buy sell our spread which is charged by our liquidity provider, because of which you can see that our ETF volumes have increased from 6,000 crores to 21,000 crores. So that was all from post them on the chat uh, on the chat, and I'll be happy to take them. So there's one question which is basically what is the tracking error of Hang Seng Tech ETF? So tracking error of Hang Seng Tech ETF, I don't have the exact data right now, but should be around 20 basis point. 20 basis point is 0.20%. So I'll just wait for 30 more seconds to see if there are any more questions. If you have any questions, please put it on the chat uh, box, and I'll be answering them. Otherwise, you can reach out to us through various social media channels and through your RM, and we'll be happy to take your questions. Yeah, I think again question from Srinivasa. Yeah, again on the Hang Seng Tech ETF. Oh, okay. So, if you're asking premium, Srinivasa, so basically all our international ETFs are trading at a premium of 15 to 20%, which is 20% because 20% back is circuit lag jata hai. Circuit nahi lagega, I'm assuming that it will trade at higher premium. The reason is that SEBI and RBI has stopped all AMCs from investing fresh uh, investing fresh money in international markets. So I cannot create new ETF units. So there is a lot of demand for FANG. There's a lot of demand for Hang Seng Tech. But I, as an AMC, I am not allowed by SEBI to create fresh units because there's an overall limit of $7 billion that has been reached by the mutual fund industry. That limit has not been revised, so we cannot as of now invest in international markets, the AMCs, uh, and that's why we are also not able to invest, and because of which we are not able to create fresh units. Now, since we are not able to create fresh units, we are not able to cater to the demand. So what is happening is जिनके पास existing units है, they themselves are marking up the price and selling it to buyers. So hence we have advised multiple times that please don't buy at higher premiums on exchange. That will impact your returns. And if you buy, you have to be very cognizant of the fact that how much premium you are paying and whether is it necessary to pay that premium and acquire such unit. So till SEBI opens the limit, we won't be able to trade at premium. So what is the alternative to buy Hang Seng market? Srinivas, actually, to be honest, I don't know open for subscription gotten redemption. But if you get redemption, you can open redemption में है. So please check out if they are open, you can probably take Sandeep Kumar. I don't have exposure to US. I have equity and invest. So Sandeep, right now, if you want to invest in US tech stocks, you have to first check out if there is any AMC which is accepting fresh money in their offshore schemes. You can choose that particular fund. If otherwise, I'll suggest that please don't invest via a stock market. Do not buy our ETF or other ETFs which are trading at 10-15% premium because you will sorts of you'll be acquiring at those ETFs at a significantly markup prices, unfair prices in a manner. So yeah, so any investment in FANG or Hang Seng Tech, etc. I think at 15% higher price right now, I'll avoid. Now, which index fund is good for investment for about 1 year? And so Kumar, I obviously cannot comment about returns because you never know, right? Nobody knows what is the uh, what is going to be a good return from a year to year basis. But I'll suggest that if you want to invest in ETF, we have a multi cap ETF, which is good, which participates in correction of small cap and mid cap and also invest 50% large cap. I think you can explore that. And if you want to look at in the index fund side, you can probably look at Nifty Total Market Cap Index Fund. I think those two are reasonable in terms of taking a position in the market and obviously investing in a manner that you're able to participate in segments which have corrected also. So there's one, two questions on active fund. Sorry, you can probably connect with your RM. In this particular presentation, I'm only talking about passive products, so I won't be talking about the active funds. Uh, See, in current scenario, what I'll suggest is you can proceed in two manner. If you want relative, and again this is pertaining to equity only. If you want a relative safety within equity, though that's probably again equity is always risky, but within that risk, if you are looking for a safer avenue, relatively safer avenue, you can look at products like Nifty 50, total market cap, and to an extent Nifty multi-cap. Multi-cap will be higher risk than Nifty 50 and total market cap, and that's the sequence. If you're looking for opportunity to sorts of take advantage of this correction, right, where what has corrected by around 70% right, then I'll highlight that you can look at Nifty New Age consumption, because consumption as a theme has the product has corrected by reasonable amount. You can look at that. You can look at but then again, I think in alpha you have to hold it for 5 to 7 years at least, and then you can look at Nifty Next 50, which is still down by around 17% or so. And again, that like I mentioned, if you're looking for a relative safety, you have to within equity, relatively, the Nifty 50 total market cap, multi-cap is higher risk because it invests 25 mid cap and small cap. If you're looking for opportunity to buy uh, uh, due to this correction, my picks will be high. These are higher risk product. Will be staggered investments in new age consumption, in Alpha 30, and Next 50. Staggered investments in these, probably in first two themes, Alpha 30 and new age consumption. You could look at 6 months staggered investments and look for a longish investment horizon. So there was one question, my Manya Verma. So consumption. So we, as a fund house, we really like consumption. Consumption is the theme which we are sorts of bullish on right now. Hard to say just 3 years. I think look at 5 years at least, and we like consumption, and within that, we like discretionary consumption a bit more. Yeah, so I think those are all the questions. Thank you for joining this webinar. I hope you will join us again when we talk about ETF Spotlight during the mid of this month, and next month when we'll be coming back again with Alpha Beta, when we'll be reviewing what happened in the month of May. So thank you, goodbye, and take care.